Hello everyone. Thank you for joining us for the monthly IMDDA webinar. Today we're covering private equity fee reporting standardization, areas of weakness and potential for abuse. My name is Andrew Borwick and I'm the Executive Director of the Investment Management Due Diligence Association, the IMDDA. As always, please send us your questions through the platform by typing them into the questions section on the control panel. We'll try to get to all of them, and any questions we don't get to we'll answer on the community forum at imdda.org. All attendees will receive a PDF of these slides, and the recording of the webinar will be available to members also on imdda.org. Now, for those of you who don't know us, the IMDDA is the only international association dedicated to enhancing the education, expertise, and networks of due diligence professionals. Members receive exclusive access to a wealth of due diligence-related information, working groups, in-person training classes, member-only webinars in addition to the free webinars like this one, plus an international network of fellow members to turn to for guidance, support, and networking through our in-person events and online forums. And we welcome many of you who haven't already to join us as a member. Now today we're proud to have two industry veterans on hand to conduct our seminar, Lorelei Graye and David Parrish. Lorelei is the plan sponsor consultant for Conifer Financial Services. Prior to joining Conifer, she served the South Carolina Retirement System Investment Commission. Ms. Graye supports and participates in all facets of the Institutional Limited Partners Association Fee Transparency Initiative. David is a partner at Jackson Walker and head of the firm's investment funds group. David's practice focuses on alternative investments, both in representing fund sponsors and institutional investors in fund formation and investment matters. Mr. Parrish also teaches introductory and advanced classes on private equity. Now we have a lot to cover, so Lorelei and David, over to you.
Thank you, Andrew. Lorelei and I appreciate the opportunity to speak with you all today about what we are seeing in the realm of fee reporting. Fundamentally, institutional investors do need to have access to information. They need this because robust reporting concerning the funds they invest in is very important for them to be able to properly manage, monitor, and evaluate their investments. People have to remember that institutional investors themselves are fiduciaries to their constituencies, and so the idea of requesting information is not just aspirational, it's actually needed for people to be able to fulfill their responsibilities. Without appropriate flow of information, fundamentally, the industry is creating long-term challenges to success. And we've seen both the press and interested parties being critical of that transparency, which will result in harm to the public perception of the long-term value of the asset class. And given the importance of the asset class in meeting funding obligations for many critical needs of the institutional investor community, we need to work to solve that. Restraining the flow of information, regardless of the basis, is just not something that is in everyone's best interests.
And I think what's now happening, and we're seeing it, a part of the reflection of the negative press in the industry from this perspective, is that if the interested participants, being the LPs and the GPs in private markets, don't work to solve the problem for themselves, then that's going to open the door for other people to try to solve it for you. You've seen it from, Dodd-Frank and the SEC's enforcement provisions under the Investment Advisors Act. You're seeing introductory legislation in several jurisdictions as to the mandating further transparency that ultimately, right or wrong, creates risk both from the GPs and the LPs, both from a portfolio construction and an investor construction perspective. And so what we can't assume is that if we don't take care of ensuring we're getting the information we need in the industry and taking a much longer-term focus as opposed to a short-term focus that I think many of the GPs have fundamentally undertaken, that we get solutions imposed upon us that don't necessarily advance the interests of what we're trying to accomplish. And I understand that you can't assume the SEC is going to give you all the transparency that you need, because that's not their job. Their job fundamentally is to ensure that the disclosures that are being made by the general partners in their documentation and in their Form ADV, the document that is available to everybody for those who are registered investment advisors, are robust. It's not to make sure it's getting you all the information. It's making sure that the disclosures that you get are truthful, don't mislead, and that the GPs avoid conflicts that have not been fully and fairly disclosed to you. So the Investment Advisors Act does not provide the keys to give you all the information that you're going to want to see.
I think you're making a really important point there, and about the fact of what their role is, because I don't think the best solution is going to come through an organization like the SEC. But they have provided us a lot of helpful information and really helped, I think, even to use the term sunlight that's used quite a lot now, open the door for us to take a look into these things.
That's right. I mean, fundamentally, we can now have the conversation around expenses and other matters, because the information has been forced to be disclosed from a legal perspective. Now, it's interesting. I don't know if people saw it this morning, but the SEC, I think yesterday, already announced that they're going to double their manpower in the private equity hedge fund compliance perspective. So the SEC is getting more robust and is building out more infrastructure. But again, legal obligations are not the entire universe of information that we need ultimately to make sure that we're fulfilling our own responsibilities internally. So Lorelei, you've probably been as close as anyone that I know to the SEC in terms of what they're focusing on and what their what additional sunlight they're bringing into the process.
Well, you're exactly right. What I was focused on, what I was struggling with was just, collecting the consistent information. And you made a very important distinction about what the SEC's role is versus, what we're trying to accomplish on the limited partner side as well, and hopefully in partnership with our GPs. But the things that the SEC has helped us significantly with is to understand and learn about things that we may not have fully contemplated, in years past. And those are the kinds of topics that they've raised were the things that we're showing here on the screen: consultants and employees and operating partner issue, allocation of funds, and so on. And I kind of want to open this up to conversation between you and I, David, but when it comes to the first example listed, the consultants, employees, and operating partners, what they were seeing was that these individuals were being promoted as sort of their funds or the advisor's expertise, and this is how they were going to generate value at the portfolio company levels. And they would be presented as employees. You might see they might have an office in the same building. They would be on the website presented as an employee or a partner. They might be in the marketing materials, etc. But in the cases that the SEC was talking about, these operating partners are instead not included in the management fee, which you think would normally cover it, but being expensed, say, to the fund or directly to one of your portfolio companies.
That's right. The key focus here is not whether or not it is right or wrong to charge operating costs from operating partners or consultants to the fund on top of the management fee. It's, have you had the opportunity to have the discussion with the GP and look at everything from an aggregate pricing perspective? Even before the SEC came out and said, oh, look, 50% of the managers are not in compliance with the Advisors Act, it's not necessarily the case that people didn't know about some of these things. It's really a function of, it's very appropriate in certain managers, potentially based on strategy and the way they unlock value, potentially to be able to have these costs charged to the fund on top of the management fee. But that's really fundamentally the question to focus on is the value proposition being provided done so at an appropriate pricing perspective. Because you look at a lot of these conversations, right, and you see now in partnership agreements where you have a bunch of new disclosures, and people say, well, wait a minute, why are you now charging private jet travel to me, or why are you now charging allocated costs of internal lawyers or accountants when you weren't before? Well, the answer is it's not that they're now charging you for it. They were always charging you for it. And what the Advisors Act does is require them now to be crystal clear that they're doing it so that you can engage in the conversation. Now, don't be surprised, though, that the costs of all these things, including SEC disclosures, don't ultimately somehow find their way back into into the LP cost burden with respect to a fund. I mean, we've had a number of conversations with people where they're saying, oh, well, our management fee is only 135 basis points. It's like, well, but wait a minute, you're charging half of your staff back from a fund from an allocation perspective, and so if that totals 10 basis points per year or 5 basis points a year, then you're really just creating the fiction of a reduced fee, not the actuality of a reduced fee.
Right. I think what you're really speaking to is, do we understand the total costs involved in this asset class? And many of these things that are on this page are really about disclosure and understanding. There are some items that might be of particular interest on the due diligence side. I would think, for example, in the allocation of expenses regarding sort of co-investments, because the SEC has indicated that, or speculated, that in the case where they didn't feel like, or they weren't seeing evidence of certain costs being what they deemed appropriately allocated to a co-invest, they speculated that this might be because of policies and procedures internally with the advisor not being kept up, so that they know as they grow how to handle this kind of information with new co-invests, or maybe they hadn't sufficiently invested in, say, the back office to perform these sort of proper allocations. But most of the items here are, in fact, about awareness, disclosure, and transparency. The expense shifting items, another one I would probably point to, because one of the things I found a very interesting quote in one of the SEC speeches was that while investors typically conduct substantial due diligence before investing in a fund, the SEC has seen that investor oversight is generally more lax after closing. And the expense shifting item is one of those things I would point to, because that was where they were seeing things that might not have been charged initially, midlife into the fund, started occurring.
And one of the things that I think is critical to focus on is what the SEC is saying. It wasn't wrong that you did it. It was wrong that you did it when you didn't tell people you were doing it overtly. So none of these provisions are illegal to do if the GP has complied with the Advisor Act obligation to disclose all conflicts, provide full and accurate information, and don't mislead you. So that's the important thing to understand, that nothing that the GPs do, if we let them do it, is wrong. It's a question of have they disclosed it appropriately so that we can have the conversation. And there's clearly been a very significant move on the legal industry to make sure that there's very robust disclosures. Now, what is interesting about it, and probably in some respects a little bit frustrating, is the Advisors Act and the whole Dodd-Frank regime bringing this into private equity was supposed to be about providing more protections to the investment community, the institutional investment community with respect to its investments. But in many respects, what you're now getting is the GP using it as more of a shield to add a bunch of provisions in that ultimately may result in an overall higher cost structure to you. I mean, I can't tell you how many times we have a conversation about, well, wait a minute, why is management compensation to executives of portfolio companies somehow a fund expense vis-a-vis a portfolio company expense, especially when you have a joint venture partner, or why does this now have a carve-out for an operating partner construct when you're early stage venture? And what's happening is people say, well, we don't do that, but we want to make sure that we have the flexibility we need to maximize portfolio value, and so we have to disclose it to you, even though from a venture perspective they're not even required to be a registered investment advisor. So what's happening now is people are taking kind of the SEC focus, and they're trying to give themselves more flexibility going forward in the future to be able to potentially do things that enhance GP value at the expense of the LPs that doesn't relate to successful deployment or successful execution of that strategy. Another perfect example of this is on co-investments. Historically, it was always the case, right, that co-investors did not bear broken deal expense unless they were sharing in broken deal economics, which was usually pretty rare. Well, now we see GPs trying to argue, and we see their counsel arguing and pounding their fist at the table saying, oh, the market's rapidly moving for co-investors to deal with broken deal expenses because of the SEC, because of the Advisors Act. It's like, well, wait a minute. The Advisors Act doesn't say co-investors have to deal with broken deal expenses because, frankly, from my perspective, a co-investment is not an expense sharing proposition. It's, you invest in something. But what they're doing is saying, well, if we don't have it right in our fund documents to have the fund bear that risk, we're not going to bear that risk, so we're going to make you bear that risk. So what happens is the Advisors Act and the changes from a transparency perspective are now getting us to the point where potentially what was supposed to be investor beneficial is actually now turning into something GP beneficial. So it's important really to kind of pay attention to what's going on and how we use the information we get in a thoughtful way.
Well, I think I'm going to guess that most of this is really driven by the fact that, as opposed to, say, a traditional asset class where you have very limited ability to control and influence in a public company, PE funds. I mean, we're talking about controlling interest in non-publicly traded companies. So I think that really kind of sets you up, David, to talk about why, in particular, is this the challenge in PE?
Sure, and I guess one thing before we talk about that, I should know, because I know there are a few questions coming in, and what we want to do is we'll try to hit those questions. For example, why would you use a partnership versus an LLC? And I think that's a discussion that we can answer either at the end, or if for some reason we don't get through the very specific questions that people have, we'll provide a document with a fulsome answer to each of those questions. And I think Andrew had indicated we can actually share that with the participants at the end, and actually also attach it to the recorded presentation. But if you go back and say, well, why are we having this challenge, right? Well, it's pretty easy, right? Partnership agreements talk a lot about provisions dealing with economics and alignment and governance, but they're very bare bones on reporting. If you really look at partnership agreement provisions on reporting, they're more focused on timelines than substantive content. And when they talk about timelines, they're talking about your standard audited financials on an annual basis or unaudited financials on a quarterly basis and your tax reporting information. LPs have different systems and resources, which we mentioned before. So they then have their own customized requests for GPs. GPs get frustrated because the biggest growth in their expense column is back office to deal with the various different kind of needs from an LP perspective. You're probably never going to have complete consistency on all reporting needs because of the different types of investors. For example, an insurance company is probably not going to need to see forecasted cash flows when a public pension plan might find that very, very important. So what happens is you've got different systems. Some people are using eFront, some people use Excel. GPs end up giving you information in a bunch of different formats that requires you to spend a whole bunch of time trying to weed through it and data entry that. Some people still send things in FedEx, some people send them in PDF. Some people send them in an Excel model that doesn't necessarily give you all the information to really analyze your investments per se and create an investment analysis across your portfolio. GPs win from an information asymmetry, right? You see it in terms. You see it everywhere. And truth be told, I don't see, and Lorelei, you can jump into this, I don't see a lot of GPs really trying to do the wrong thing. The problem is that there are people that do, and those that do create a big stain on the asset class from a long-term perspective.
I I couldn't agree more. From my own experience, that that's exactly the case, and it really speaks to me as far as the bare bones of the LPA agreements as well.
So as you look at that, we're in the situation where GPs only want to give you what you want. They will give you what you want. It may not be exactly when you want it or how quickly you want it. They're looking at things and saying, look, I've got multitude of different reporting templates. So what's happened, right? And I think ultimately what's happened, and it's driven in large part by the frustration of investors and the negative publicity around this particular topic. You've now seen a huge push for standardization to really give not just the information somebody's system is built for, but all of the information they need from a diligence perspective to properly evaluate the operational and investment risk in deals. And so Lorelei has been incredibly involved in that part of the world. And so Lorelei, you want to take us through kind of what you're seeing?
Certainly, certainly. So a lot of my initial exposure to this was when I was brought on board at the South Carolina system to do a reporting project, which I didn't actually know the length of time or extent that would be that would end up ultimately taking, because in South Carolina we had a state statute to disclose the investment expenses of the plan and to do so on a fiscal year for the public pension system there. So went in trying to build a sort of controlled process to collect and report this information on a fiscal year. But, and I'm very proud of the team, the folks there who really worked very hard on this. It took quite a lot of effort, but what I found mostly were limitations. And I've got an example on the next slide about this, because, let me switch over there, because what I've drawn up here is actual sort of screenshots. Can I advance that slide, David?
Yeah, is that to your contrasting quarterly statements?
Yes.
Can you see that?
Right.
Yep.
Got it. Perfect. I couldn't quite do it there. But what I did was try to pull two examples, actual real-life examples of some quarterly statements that many of the folks who are on the due diligence side will see, but I know we have a mixed audience, so I really wanted to draw a picture here. But this is an example of what I was seeing in the variation. It's substantial in format, the amount of details provided from one investment to the next on a quarterly basis. If you're with a public pension, obviously you typically have a June 30th or similar fiscal year in, and it just took hours upon hours just to collect consistent details. And that was only at a fund level, not to mention the fact that if we had to end up developing a template in order, one of those many bespoke templates that David referred to earlier, but a template to collect this information, implement it with our managers, and because we're getting it in a custom format, a non-standardized form of reporting data for public disclosure in our case, then you also have the necessary validation efforts to gain assurance before you disclose this kind of information. I realized it's an industry-wide issue, and we could not be the only limited partner out there struggling with this. And so that led to my interest in working on a white paper on this topic. I reached out personally to the leadership at the firm called CEM Benchmarking to discuss collaboration on a white paper. I wanted not to draw attention necessarily to a stopgap solution. I wanted to draw attention to the links that LPs must go to just to collect this information. And my hope was that, you know, it would draw attention, it would be this rousing call to action was what I described it to be. It ended up being just that. It was released last April of 2015, I believe. Suddenly LPs and providers around the globe were reaching out to me, as well as the ILPA, the Institutional Limited Partners Association. And they reached out because they were about to launch a working group on this very topic. They invited me to get involved. I suggested that maybe we should look at a solution as far as a very specific defined template. And I began recruiting the very organizations who had reached out to me about the white paper. During that time, and we've got some information here on the screen that was provided by ILPA, during that time we found proof of that proliferation of these templates. Those are just some actual examples of multiple different LPs who were creating their own and trying to collect this data in some sort of consistent fashion across their portfolios. Something of interest is that I think it was over half, you see there on the screen, 52% had requested additional data, at least on a one-off basis, and had begun issuing these customized templates. So the workload certainly was adding up on the GP side. But my thought was that if we spend all of our time trying to collect consistent fee data, minus time that we're not able to measure and compare or to better understand the economic impact of the terms that we've negotiated on these deals as the performance play out. So ILPA found a broad interest in getting a better grip on this cost and compliance to those LPA terms. So what ultimately, and that's some data about the different sorts of organizations and the increase in that interest. Obviously, pensions were edging it out probably slightly more due to the public exposure, but I think every organization nearly had some high level of interest in doing just that. Ultimately, on January 29th, on the next slide, is a screenshot of the ILPA template. It was released this year. And it's the result of a collaboration of many limited partners. They're providers, and it's a broad representation of GPs, both from some who actually had direct participation and were very helpful, and a number of GP-centric organizations or associations. The hope here, and I'm not going to go over every line in detail, obviously, on this presentation, but the hope here is that the ILPA template will become part of the core LPA documents. I think David is probably well prepared to further speak to the LPA language in this case, and I imagine you would probably agree with that hope.
No, I mean, look, at the end of the day, right, we need to be able to understand the true cost of an asset class and appropriately value that vis-a-vis other asset classes. We know the private equity asset class is more expensive, and it's potentially justifiably so, given the potential returns, but we can't make that statement as to whether or not it's appropriate from a cost perspective vis-a-vis other asset classes until we truly know what these things are, right? So, and I think ultimately people are looking to have, consistent data from a reporting perspective. So the question is, how do we get there, right? We mentioned before, right, that the LP agreement provisions on reporting are not robust, right? And you've got provisions in documentation where GP Counsel says, look, the only information you're going to get is what's set forth in this partnership agreement or this LLC agreement. You're waiving any rights, or if you're asking for something else, we'll give it to you, but no one else can have that information. Tell us what you need. Then what happens is GPs, turn around to everybody else and say, well, it's getting more expensive now, so now you need to pay for what you need vis-a-vis us. You've got information sometimes where the GP can withhold information from you entirely if it would not look favorably upon or have an adverse consequence, not to the fund, but to the GP or the sponsor. So you're putting these provisions in place from a GP perspective to really try to control the information flow and potentially advantage one party vis-a-vis the others. So the question is, what are people doing about this, right? So this template has been released. It did in fact have GPs involved in the process. There was a very strong desire to say, look, we need this level of detailed reporting because ultimately we need it from a fiduciary perspective to appropriately diligence a particular manager and its expected investments, and then be able to monitor that along the way and not have to hunt and peck or try to have an increased investment on the investor side in back office, which quite frankly nobody wants ultimately to have. So the GP reaction is what, right? By and large, even some of those GPs who are involved in the template analysis have said, well, we don't want to adopt it just yet. We want to see what our LPs want. And if our LPs want this, then we'll give that. If not, we're giving everybody the information we think they want. And by the way, even if we gave them all this information, what would they do with it? That last statement from a GP perspective is really wholly irrelevant. It doesn't matter what we do with the information we have. It's whether or not we're entitled to receive the information. And what is always lost in investment management is that we're not a financing source. we're a partner, and we acknowledge that we're not going to generate the returns without a manager's ability to access deal flow, operationally improve those companies, and realize returns. But the ability to access deal flow is worthless if you do not have the capital that's needed to actually execute on the closing of those deals. So there has to be a fundamental long-term understanding that what is better for the asset class long-term is better for each individual GP. Now, LPs, from what we're seeing, are very reluctant to mandate the disclosure of the template. It's of all the clients we deal with, we've really only had one that has mandated the actual use of the template. We have a couple of others that mandate certain levels of fee and carry disclosure, but we've only got one LP who's drawing a line in the sand and saying, if you don't give this to me, I'm not going to invest. And I think it's not wrong to not mandate the use of a template, because at the end of the day, each investment has to be looked at on its own from an underwriting perspective. But it's certainly, if GPs are not getting a cohesive response from the LP community, or the GPs are not utilizing the ability of the template to reduce the total reports they're actually providing to people, you're not going to get the level of success that you're hoping for. And to the extent that a GP does agree, for example, with that one client who says, you have to give this to me, you'll note that their most favored nations provisions in their side letters with those investors carve out everybody's reporting. So not everybody's getting that exact level of reporting from that perspective. So it's going to continue to be a real challenge if the industry as a whole does not step back and take ownership of saying, look, at some point we have to stop looking purely at short term, and we have to look at what's best for the asset class on a long-term basis. If not, you will absolutely be in a situation in which you have other interested parties, whether it's regulators, whether it's governmental officials trying to step in and mandate an outcome in a way that may create risk. It may be appropriate risk, it may be inappropriate. Each investment has to be looked at, and risk itself has to be looked at on a pragmatic basis. But it creates a risk to us. So Lorelei, you've seen a few things happening both in California and in Illinois. What are you seeing, and where do we see this information killer/transparency mandate headed?
You're exactly right. There's some proposed legislation both in California and Illinois, and so I'm trying to follow that very closely. It is summertime, so we'll see things pick back up in the fall, but primarily what you're seeing right now is an interest in two parts. One, it is the disclosure of advisors to public pensions, and then the other side is the disclosure from public pensions to the public. And right now I think the California bill where we stand, it's passed out of Assembly. It's now I think in the Appropriations Committee on the Senate side, so it is moving right along. It does have provisions for the disclosures at least on an annual basis of fees and expenses that are paid directly, those that are also deducted, whether it's from a distribution or other means, including carried interest, the public, and also the public investment funds sort of pro rata share of any fees and expenses paid by all of the portfolio companies. In Illinois, from my information I got from somebody very close to the bill, explained to me that the bill had passed the Senate, it's awaiting consideration in the House. So we could see something at least starting to happen by November, but if it did pass, it would be by early January, I suspect. You can find information individually about these on their sites, but on the Illinois side, it is definitely focused. I think it actually actually mentions the ILPA template in some of the language directly, but it also is requesting disclosure of such things as the management fee waiver provisions, indemnifications, clawbacks, fees paid directly or also deducted from distributions, just like the California bill, and fees paid by portfolio companies. These are probably, I suspect from what I understand, they're watching both sides very closely to see how the other plays out. And I did hear something this morning, David, you might know more about it, about some other bill in California related to sort of regulations.
It does. Yeah, and that legislation is focusing on disclosure of partnership agreement provisions in terms of clawback and clawback calculation and things like that. Look, there's not a yeah. Go ahead, Lorelei.
I was going to say, which sounds a lot like mirroring the Illinois bill as well, but go ahead.
Well, you're not going to find more LP-friendly or investor-friendly people than Lorelei and myself. I'm not saying that there aren't people who are as friendly as we are, because there's a lot of really talented people out there. But and I am a fundamental believer that we, to fulfill our jobs in institutional investors, regardless of the role, diligence, investment underwriting, investment oversight, we must get the information that we need to effectively monitor and evaluate our investments and our managers. And because if not, we don't have the ability to make as fully informed decisions as we should. So we need all this information because it provides the information that we have to do our jobs and to do them in accordance with the standards that we are subject to. What you see with various different legislation is the fact that the industry itself has not worked to solve this. So now you're getting a version in California, or two versions in California, maybe a version in Illinois, and maybe you'll get something different in Georgia or New York or Maine or Alaska or Texas, right? And for this, for all of the participants in the industry, there's plenty of people probably on this phone call who are not at public pension plans and say, well, this doesn't impact me. Well, it does impact you, right? That's because at the end of the day, the cost structure is growing, and as LPs, if individual bespoke requests are not passed along solely to the partner requesting them, we're all paying at the end of the day for the GPs to incorporate these things. We can say all we want, right, that the GPs are not going to shift excess cost from themselves onto us as their back office grows. But the fact of the matter is, GPs are very commercial actors, and they're not going to reduce their economics voluntarily. So these things are impacting us, and in some ways maybe positively, in some ways negatively. The question is, is the disclosure, like what disclosures goes to what constituents? I mean, is the solution to getting better terms to mandate public disclosure? I mean, to me, I read that as, well, there's a structural advantage to GPs in terms of how they raise funds, and it's too good of a deal for them, so we'll shame them to change. Well, I'm not the most, I might be actually viewed as one of the most cynical people in the world, because the glass on my desk is not half empty, it's half empty and somebody's just about to kick it, and it's going to spill everywhere. So we have to fundamentally understand that we need this information. It's about what's the right place for it, and should it be done on a patchwork basis. If you think about it, even if you are a public pension plan, new legislation mandating disclosures creates risk in of itself that is very hard to quantify. If you think of your portfolio construction as a shopping mall, you have your big buyout groups and your anchors in your portfolio that get a large portion of your allocation. You've got your lower middle market people, your distressed for control people, you've got your credit folks, you have your real assets investments, which are always done through private markets structures, absent core, which theoretically is somehow open-ended. You've got your venture portfolio, you've got all your specialty retailers, and you've got your big tenants. It is not necessarily the right thing for a GP to say, look, if there are certain investors who disclose things, I don't want them in my fund. And we can argue about the merits, and is that a rational fear from their perspective? Is that appropriate? Will they all act that way? Well, they're not all going to act that way, but some may. And whether if that's a small percentage of the portfolio or a large percentage of the portfolio, there are GPs out there who would say, look, why do I want XYZ investor in when I have ABC investor who doesn't provide some of the same challenges to me from a risk disclosure perspective? And all of a sudden now you're in a situation where either on a secondary market basis or an access to an X fund, you now have to replace something that you have thoughtfully put into your portfolio. Now, it may very well be that the replacement generates better returns for you from that perspective, or the same returns. It may be that they generate lower returns. We don't know. It's just created risk. A patchwork approach creates portfolio construction risk for us in a way that is not compensated. Right? We don't get compensation for that additional risk that we're undertaking. And by the way, if there is something that in the short term, and you saw it from some of the venture funds when some of the California investors had to exit investments because they're subject to Public Records Act issues in California, you now have a hole, and you got to fill it temporarily and on a long-term basis. And so that is creating more challenge to efficient portfolio construction, all because we as an industry have not decided to solve this for ourselves. So I'm not against transparency. In fact, I'm probably the biggest proponent of it. It's about appropriate transparency and ensuring that our investment staff and our investment teams have access to the information that they need to do their jobs. And I think in many respects, yeah, go ahead.
I was going to say, and I think that's precisely what staff internally are after. I have heard the very same concerns, irrational or rational, about certain rules or regulations putting them at one particular or one group of LPs at a disadvantage to some of their peers that are not subject to the same rules, for example,
yeah, I mean,
disclosure.
Look,
I don't want to get into a full discussion of FOIA, but, yep. But go ahead, David.
Well, I think that at the end of the day, that's what people need to realize. Like, all LPs are not do not take the exact same approach, and if you're in an allocation environment, you're going to want to take advantage of whatever benefit you have to increase your allocation if that's what your desire is. It's just ultimately, if we get to a position where we let someone else solve the problem for us, then it's just going to create more expense, more cost, and more frustration on an asset class overall.
I think everybody can agree that they would rather set the rules from the LP/GP side than to have someone from the outside do it for us. And that's why I think probably, folks who are against this sort of movement are being a bit short-sighted, because I think it's inevitable that this is going to happen. It's sort of the cat's out of the bag. It's not going away, I suspect, at least for the public pensions. But I'm really hoping for a broader solution. Now, there will be some pioneers. There will be folks leading the way, some of this legislation like we're seeing. And but on the other side, I'm also seeing some great things. I saw a recent Wall Street Journal article where I think 3 different GPs actually mentioned publicly in that article their expected rollout date for the ILPA template of 2016 and 2017, which that's a very exciting trend to start to see to happen.
Now, at the end of the day, as we bring this all back to kind of the whole point of due diligence, is we've set the table, we've kind of talked about all the challenges, and we've talked about why we are where we are and what tools are now available. I think if people really do spend time looking through, from a due diligence perspective, the ILPA template, it really does give you a very strong roadmap to help underwrite your particular investments. If you look through that, and Lorelei, correct me if I'm wrong, but is this available to the public on the ILPA website?
I believe so.
If you look through it, even obviously there's benefits both from a diligence perspective and an ongoing diligence perspective in connection with your investments. Because Lorelei, you're right. The SEC has said people have done great diligence on the front end, but then it kind of falls off once the investment's made. But if you use the template, you can, and if the GPs will work with you to fill out the information, it really helps you analyze risk with respect to the particular investment, and it also helps you negotiate terms. We can all say, oh, we want 100% fee offset. It needs to work this way, and it needs to be the case that at the end of the day, if there's excess, it's paid back to the, or there's excess transaction fees charged that exceed the management fee, it needs to be paid back for us. And we can talk about, insulating that risk of, or making sure that doesn't happen in fund documentation. But if a manager doesn't really charge those things operationally, then maybe you don't want to spend your time on a diligence and legal negotiations perspective negotiating for a term that has very low impact with respect to that particular manager, because it doesn't happen.
Right. I probably should correct. Some of the due diligence tools I think are available to ILPA members. I think the organization is set up in such a way that your entire group can be a member and you would all have access. But you can definitely go to ilpa.org to get more information about membership that way. But I think you're touching on something really important there with what you're saying, in that, when I come from the operations side of the world, an accounting background, and when I would talk to the investment pros on the other side of the operation, when they talk about fees, it's typically in the perspective of negotiating a new fund, and you would hear the terms that you typically hear, 2 and 20, clawback provisions, what kind of offsets, sometimes the word rebates was used, etc. But what's really coming to light is that we understand the terms initially, or we think we have a very good picture of the terms initially, but down the road, as the performance plays out, what's the actual dollar impact of those terms that we've negotiated on behalf of our beneficiaries, in the case of being a fiduciary, right? What's the actual dollar impact of those terms as the performance plays out? And that, I think, is the knowledge that we're really after, to be able to measure, to be able to compare and sort of benchmark that in relation to, and you can never look at expenses outside of risk and return, but to look at these actual costs as they play out in that perspective. And that's what I think we're really after here.
I think that's exactly right. I mean, at the end of the day, we want to make sure we're getting the information we need to underwrite that operational and investment level risk from the portfolio selection. And ultimately, it doesn't just help on the front end, but it really helps along the way. So you can make sure we're monitoring our investments and evaluating whether or not we should be continuing those investments in a current fund basis if we find it appropriate and not sell in the secondary market, or if we want to move a different direction. Because it'll also help us truly understand the cost of each fund. And so if we're comparing 3 or 4 sponsors from an investment selection or from a relationship perspective, and if we truly understand the cost because we have the information, then we're in a situation where we can decide whether or not we want to continue the relationship we've had with one manager or go in a different direction to somebody who's generating higher returns to us on a lower cost basis.
Precisely. And we have seen some things, I think, as our knowledge increases, as our understanding expands on the types of fees and costs that can be to the GP or to partners or other expenses outside parties. What we're seeing is certain trends, I think David could speak to on the future LPA terms, but one of the things I've observed is that there has been a trend, at least from my anecdotal evidence across my peers and folks that I've talked to, is that there's a trend in the offset or rebate to the management fee, something where we did not have in the past typically on the LP side, but now you're starting to see these terms where you have a 50% or 75% or 100% offset to your management fee on behalf of the types of fees, the monitoring fees to the portfolio companies. And I think that is one example of the evidence of the trend that you'll see as our knowledge increases.
I think that's right. So with that, I think it probably makes sense, Lorelei, for us to go to any Q&A. I know there was one question that came in, which is, people are getting responses, from some of their advisors saying, look, we're talking about partnerships, not limited liability companies, and limited liability companies are effectively now the flavor of the day. Is that right? And what does that mean for us? I guess I would say that I don't see that. I see it occasionally. Now, no one sees the whole market, but we represent over 90 institutional investors in their public and private markets investments, and we see a huge portion of the private markets world. And I only see limited liability companies, occasionally, probably less than 2% of the time. Fundamentally, there may be a drive as the IRS looks at, the right way to tax a carried interest, whether it's ordinary income or whether it's a capital gain. There might be solutions people are trying to drive to that would mandate the use of a different structure or have the GP invest or generate its returns outside of the quote-unquote fund environment. But fundamentally, a limited liability company and a limited partnership are going to operate the exact same way from a management control perspective and a fiduciary perspective, because the jurisdictions in which most funds are formed, whether it's U.S. focused, looking at Delaware funds and offshore vehicles in Cayman, or whether it's Asia focused, you seeing Cayman, whether it's European focused, seeing UK funds, we'll see what happens with Brexit there, or the Channel Islands funds, Jersey and Guernsey, or Luxembourg, or where have you, from an organizational perspective. It's going to work operationally the same way, and so all the terms are going to work the same way. There is a risk from a tax perspective to a GP to have a carried interest in an LLC, and at the same time be the quote-unquote manager of that entity, which is no different than the general partner of a limited partnership, that you could end up paying self-employment tax potentially on all of your distributions that you can structure sometimes around in a partnership environment. So I don't really see a flavor of the day. I see people generally utilizing the same structures they've always utilized. Nobody wants, especially in a re-up scenario, to be in a situation where you get a red line and there's marks all over the place because you've fundamentally changed your structure. It happens from time to time as people kind of morph from offshore Europe to UK based and some of the European managers, but it really is not the typical situation to see a GP who wants to put a burden on its LPs to have to reread and re-underwrite the entire structure in the relationship. I have seen it a few times. I've seen it more in the private markets real estate side than I have in the private equity side. I haven't been able to check, Andrew, but are there other questions that we've had come in that we ought to answer?
Yeah, we had one more come in. Actually, a couple more popping up. We'd like to know, can you expand on what LPs are not doing down the line? Post-investment on fee impacts since the manager reports carry and management fee.
So that's the question is really, are you getting the reporting on the carry and the management fee, or are you getting information about the management fee only if it's paid out of capital contributions as opposed to operating cash flow, fee offsets, or debt? And what does that mean? And are you getting the information about the impact of those portfolio company fees? I mean, you often don't see the agreements, unless you're a co-investor, that the managers enter into from a investment banking or monitoring or director fee perspective at the portfolio company. And what you can be surprised to find is there are situations in which a manager can get 15 years worth of management fees, assuming their management fee runs throughout the life of the fund and doesn't end at the primary term or substantially step down after year 10, but they get it in year 6 or 7, and they continue to charge transaction fees. So you can have a situation where your manager is getting its fully loaded management fee in 6 years on a fully undiscounted basis and continuing to be able to charge transaction fees, which will come back to you if you negotiated for it, but that may not happen for another 6 to 7 years. And then there's a question as to, people think about 100% fee offsets. Well, it's not always 100% fee offset. Usually it's 100% of the LP's capital share of the fund's share of the offset. And if there's co-investors, it's even a lower percentage in terms of what the dollars that are actually happening. So if the GPs will tell you, well, you get the financials, you get the audit financials, you can see everything in there, but you're not really seeing the economic cost of the fees being charged to the portfolio companies. Now, the good news is, right, I mean, this is not just value that's completely escaping, because if you look at portfolio company exits, one of the things you'd say is, well, gee, if they charge all these fees, then our portfolio company is going to be worth less. Right. Well, that's true to the extent that that revenue would otherwise be used by the management of the portfolio company for productive uses, which is not always the case. But if you do extract that additional value, and it ultimately does come back economically to the LPs, and the buyer of the portfolio company adds back the fact that those fees are not going to be recurring once they own the company to the EBITDA calculation of the portfolio company before they apply the multiple, then what happens is that you're not truly economically as disadvantaged, but you still don't see the picture of how valuable the cost, the offset approach is, and how much revenue can come out of the economics that doesn't ultimately come to the LPs if you don't see that information. So it's really about saying, look, what does it really cost us? What are we paying you? We will all pay. We would all love to have it be 2 of 20 or 150 basis points of 20, but it's not. It's and. And so the question is, when we do that and we try to understand the cost, do we truly understand, on a present value basis and on a current basis, what the cost of that asset class is?
Right. And I think part of that question might have been speaking also to, it's not sort of, it's not sort of a set it and forget it when it comes to costs. Are you monitoring ongoing or not? At least that's the way I took the question about what are we not doing down the line post-investment. So I saw also another question pop up about due diligence regarding fair valuation. I know we're running out of time, but David, I don't want to wade into this with 1 minute to go.
Well, why don't we just address it quickly? So from a financial auditor perspective, they're going to be coming in and looking at controls, valuation policy, and doing sample tests. But they're really ultimately, at the end of the day, because these are level 3 assets, going to have to rely upon the GP's analysis and test as to whether or not the GP is using an appropriate analysis, whether it's public comparisons, right, publicly traded comparisons, whether it's a discounted cash flow analysis, whether it's some other model that they're using from that perspective, and how they're addressing from a mark perspective. It's interesting, though. You can still see funds that you're in where you have extra exposure to the same asset, but they're carrying them at different costs. So you can't assume your auditor is a be-all, end-all solution to make sure you're getting full current fair valuations. Ultimately, you've got to make sure that there's an audit approach in place, that there's a valuation policy that's that you're comfortable with in terms of how they do things, and then otherwise, if you still have concerns, that you figure out a way to either have an advisory committee role around valuation methodology, not valuations themselves, because I don't think the advisory committee members are really auditors or accountants from that perspective.
Right.
All right, I think that's about all the time we have. We're right at 2 o'clock. Thanks, Lorelei and David. That was fantastic. I mean, there's a lot of useful information there. And again, for everybody who needs to review the information, where the recording is going to be on the imdda.org website. We're going to share the slides. And if there are any questions that we didn't get to, or if you have additional questions, you could go on imdda.org in the forum and ask them there as well. And thank you, everybody. It was a fantastic webinar, and we hope to see you again next month.